on that day is easy. So it's worth it for me to take that risk on a Monday. It's worth it for me to push in there and pyramid a position. It's worth it for me to do that because I've been doing it long enough. I've seen it. I have the data behind it. I've seen this happen for decades. For you today, you're learning about it for the first time. And I'm reminding you, don't take my word for it. Go into your charts and study it. Collect the data yourself, because once you have it in your own hands and you see it, no one's going to tell you otherwise. No one's going to discourage you with their bullshit posts and made up bullshit. Okay? You can see it for yourself. That's important as a trader. You have to have your own evidence. You have to be able to see this in your own charts, being able to say, okay, yeah, I see this panning out. But don't be in a hurry to see that panning out in your charts. And then, okay, I've seen it one time. Now I got to go out and try to do it with a live account, or I got to try to do it with a funded account. That's the mistake that 99% of my students and everybody else's students, when they think they have been introduced to something enough, to let me go out and try it. That's not what you want to be doing. Not in these markets, you don't. You don't want to do those types of things. That is a recipe for failure. And I try to do everything I can to build you up psychologically, equip you mentally, so that way you don't fall victim to the traps of fear and greed. And even if you are profitable, don't go into the pride and ego aspects of it. Because when you start doing that, any small little loss will feel monumental, and you're going to make it bigger than even your audience would. So there's a tight wire act that you have to walk your entire career as a trader. Until you stop doing this, you're walking a tightrope. And it's so easily done that you fall off. You can fall off due to one of your strengths, and you won't even see it coming. And social media is a perfect apparatus to bring that out of all of us. All of us have that tendency. You want to defend your position. You want to belittle someone else because you're miserable. You want to compete against somebody else's methodology, their service, their way of interpretation. You just want to be significant. You know, all those types of things. That's what social media was devised for division. So inviting that into trading is literally stupid as shit. It's dumb. But if you have a service, if you have a means of operating something, then yeah, I mean, it's a tool. But treat it as a tool, not an arena to invite toxicity, because it's easily done where it'll be distracting to you, and you'll start measuring things that are not really all that important, and it'll distract you from the things that are. So when I'm drawing out on these charts, like this fair value gap in here, in my mind, what I was interpreting was, does price want to react off of that? And if it does, I want to see how fast it can reach to the lower quadrant, which is this level here. So if we measured from the low of this blue shaded area all the way up to the top and divide that in half, that's this level here. That's consequent encroachment, because it's an inefficiency on the daily chart. The lower quadrant, I want to see how fast we reach up into that. Whenever I have an inefficiency, whenever there's an imbalance at any degree of a draw, or it's ahead of a target that I'm reaching for, but I think it's ultimately going to go through some kind of let me make sure I say this correctly. Let's say that I was wanting to see 14,500, which would have been outside the scope of the price range that's being shown here. Okay, like say I believe that's what I wanted to see happen this morning. And then we also have this daily volume imbalance still. I would not be so inclined to take all my profits off in here. I would take about half, and then 80% would be up here, and then see if I can reach that target. But because this is my target, I want to see it trade up into this area here. I want to see how fast we trade up into that lower quadrant. Does it do so real quick? Well, look what it's doing here. It's hitting the low end of it here and consolidating. Now, as soon as it does that, I'm looking at my immediately, what's the closest proximity discount array? It's this order block. But we're also trading real close to what would be mean threshold of that. So I have to make an allowance for what? There's got to be 3 PD arrays. 3 PD arrays that every single time I'm looking at price as an entry, or if I'm moving my stop loss, I have to have something that's framing it where there's 3 PD arrays that would otherwise be used as an entry. If they're not respecting price, all 3 of them fail, then I'm wrong. That's where I'm placing my stop loss. Every single time I'm moving my stop in profit, never opening it up wider. When I add a pyramided entry, sometimes it'll make the stop loss move a little bit, and then I quickly adjust it to where the risk needs to be based on three specific PD arrays. So if we're looking at this down close candle here, and on this candle here, I'm watching price. While I'm not using it as an entry because we're in the target, the low end of where I was seeing it as a draw, which is the daily volume imbalance, that blue shaded area. We can't take a we can't take a pyramid there. We got to be in the mindset of taking partials. So as it's digging in to this blue shaded area, I'm measuring how much time it takes to get to the first lower quadrant. So we hit it here on the low end of the blue shaded area. We consolidated. We have 1 discount array here. How's that a discount array if we're so far away from your entry? Because this is unrealized up here. The upper part of that shaded area. Remember I was talking about this is a implied dealing range. It means it's not there yet. So if I'm buying down here and I think that the market's likely to draw all the way up here, best case scenario, which is the terminus level of 14,467.5, the upper quadrant or upper level of that blue shaded area. That's what I anticipate seeing price do. I want to see it traverse from here all the way up to here. And I'm willing to submit to the time that it takes to get there. But is it logical? Is it sound money management and trade management for me to just simply demand that's all I get out of the trade? Hell no. No, absolutely not. And especially, moreover, if you're a new student, if you're someone that's trying to learn how to do this, you want to have logical places predetermined where you're going to take partials off and be comfortable doing that. Because taking wins with logic that repeats, number one, it doesn't feel like luck, because if you're following a process or a protocol and it's giving you the outcome that's measurable and it's gainful for you, that's not luck. You're conditioning yourself to anticipate following a procedure, a process, protocols, a model will yield you results that are favorable versus, well, last time my elbow hurt like this and it was raining, the euro went up 50 points. I could probably get 50 points today if I go in here and trade that. That's impulsive, that's stupid, and that's many times what people do. Or they sit down in front of the charts and like, oh, I got time to do something. Oh, it looks like it might go up there. Why would it go up there? I don't know. I just got a hunch. It just feels like it might go up there. And then you find yourself pushing the button, getting in those trades, and you're wondering why you're losing. Because you're not following any logic. You're not using any basis at all upon which the market itself will refer to as a reason or a catalyst for price to go higher. That's what I'm teaching you. I'm teaching you technical science. This shit does not just happen because I'm pushing a button. I'm pushing the button because I know it's going to happen. That's the paradigm shift that has to take place. And I know there's a lot of people out there, some goober out there, there's no edge. There's no edge. Motherfucker, I'm out here with twin katanas, swinging them every fucking week. Laser precision. There's no more finer edge than what I'm showing. Okay? There's no finer edge than this. This fucking glass trophy, shove them up your fucking ass. Go in that Robbins Cup, and we're going to see who's got an edge. Okay? So many people in this industry have believed that they have something of significance because there's so many glad handing. Oh, well, you have a title here, you have a title. Fuck your titles. Fuck all that bullshit. What are you able to do? Because doing a lot in this industry is like 20 to 30% a year. This was 18 fucking percent just in this trade. Just in this fucking trade. And it was done poetically with such a degree of precision using the very things that I'm teaching and have already taught. These are things that my charter members, they know these things. You know them because I've made that content public on the YouTube channel. And none of it hinges on anything else you've ever seen. Just because an area is shaded doesn't mean that's a supply and demand zone. Sam Seiden never taught this kind of stuff. Chris Laurie didn't teach this kind of stuff. Okay? I'm just telling you, that's just the way it is. But you're not going to learn it real fast either. And I never said you would. I said I would make it easy. I would make it easy for you to go through the process, which is me encouraging you constantly, giving you examples of it, me using it, giving you something to study with. Because if I can't do it, then it doesn't exist. If there's no algorithm, the things I've talked about, the things I've teach, and the things that I drone on about, like I'm doing here and on Twitter Spaces, that wouldn't hold any, and it wouldn't hold any water. And my students wouldn't be able to find any efficacy in using it, but yet they are. So if there's an element of time that's being a large influencing factor in when price is going to do something, okay, it's important for you to understand where they are. Not trade on the basis of patterns for pattern's sake. That's not the importance here. The importance is knowing what the market is drawing towards. Why should it have gone up into this blue shaded area at all today? Because we're extremely oversold and we don't need an indicator to tell us that on the daily chart. It's been pressed down a lot all last week and for a month or so. It's gone down. We were looking for this very event to take place. We're not surprised by it. We didn't wake up last week and say, man, look at this. Where'd this come from, right? We outlined quarterly shifts that takes what? Months to develop and deliver. Now, you might not have the ability to hold on to those types of trades. But even if you don't, you have to understand the benefit of knowing what it's likely to do on those higher time frame weekly and daily charts. It's important to know that because it'll help you determine where the emphasis should be placed on your draw on liquidity. In other words, the trades that you're trying to frame, if they're inside of that logic, whatever you think is going to happen on that weekly and daily chart, I guess classically defined, we can call it a top-down perspective. Buying in itself, just because you want to call it or label it a top-down analysis, you still have to know where you're getting in. Because we can sit on the sidelines and embark and say, oh, this is everything else. This is just top-down analysis. Everybody does that. I don't see everybody else doing this. I don't see it. I see my students doing it. But outside of our community, I don't see anybody doing this. I'm not saying they can't have winning trades. That's not what I said here. But to the degree of precision, why and when it's going to move like it's going and where it's going to, nobody else is doing that. Nobody else is doing that. Because there's no rhyme or reason outside of what I've taught that causes price to go up or down at the time at which we anticipate and expect it. That's a macro. A macro are small little intervals in time. Okay? They're always 20 minutes. There's a 20-minute cycle that at specific times of the day, if this macro is going to be employed, and there are times when it won't, that's where I'll get it wrong. I may have to sit in more drawdown than I'm willing to and measure and weather a drawdown in a trade to see if it wants to move once it gets to the next level of which time is going to tell me it's going to move. Or it hits my stop loss. Or it moves enough for me to say, okay, I'm going to take half the trade off. Or close the trade. Now, just that statement alone takes 5 fucking chapters just to scratch the surface of, because you want someone to sit down here and say, give me a 5-minute trainer. How the fuck can anybody give you all the reasons why any one of those things could be considered for your trade that you're in right now? It takes a lot of other supported topics and experience having seen price action. But some of you are so new and entitlement minded, you think that you are owed everything the first single time you sit down with somebody, not just me, anyone. Well, give it to me right now, and I've already waited too long. when I've already told you this is going to take a lot of time. It's going to take a lot of effort, energy, and it's going to be met with a lot of adversities that most people aren't equipped to endure. But if you're willing to endure it and study and stick with it, you will be able to see price in a way that nobody else does. They're still trying to clamor and make excuses about there is no algorithm. And the people, these old hats, they know because they were in the floors. They were on the floor in the pits. And they know there's something different right now. Something different going on. Yeah. It's 100% electronically controlled. Where it was manually controlled before, still, now it's 100% AI. It's been AI before AI became a talking term. You can't argue with this, folks. You can deny it. There's nothing wrong with denying it, and you can claim that it isn't there as much as you want it, but it doesn't change the fact that it is. Just the separation between these two candlesticks here. This is a volume imbalance. Volume imbalance is the same thing that's shaded here in the blue area. That's on a daily chart. It's a larger range. Okay. Now, because this is the part where you write shit down, folks, but because you want to listen, or you're working, or you're driving, or you're doing something else, or you're falling asleep, you're not going to write this stuff down. And it's going to go right over your head. And other people are going to learn how to do this, but you were here listening to it too. But you won't get it. The higher time frame, the larger the imbalances, or like in this case, the volume imbalance, it's a larger range. The smaller the time frame, the smaller the imbalance. So if we're going to be using a higher time frame, for instance, like a 4-hour daily or weekly, I'm absolutely interested in the quadrants. Anything less than that, I'm only interested in the low, the high, and the consequent encroachment midpoint level. Because this is a daily volume imbalance, I want to know where that first quadrant is and how fast does it reach up in there. It does it real quick and energetically. And what is it telling me? What is it telling you? Where did it close on that candle? When it hit it, what did it tell you? Did it close below it? Nope. Closed above it. That is a signature. Okay? That's a signature. Listen, I'm going to tell you something right now, and I know some of you don't want to believe this. You think it's all hokey bullshit, okay? Some Tom Clancy bullshit, okay? But it's not. It's really real. The algorithm that delivers price, there is a class of trader that is actively among all of us. They're not out here trying to draw attention to themselves. They are cannibalizing everything. Okay? They have created high frequency trading algorithms to do a lot of what they do. And when these things like this happen, it tells their algorithm, like I have Enigma. Enigma is not what books price. Enigma, it handshakes with the algorithm that delivers price. And what does that mean? My algorithm would see this close above that upper quadrant and say, okay, now I can take a long if it trades down into a discount array. So it's going to have to go back through. Where are we at right now? We're here. So go back down. We have consequent correction of this wick here. Opening of this order block, mean threshold. So is it permissible to see price wick through mean threshold here, but not close? Yes. Does it do that? Yes. Does it close below mean threshold? No. Does it close below the volume imbalance here? No. So where's price going to go? Higher. Every other person that is deemed smart money, central bank level, cannibalizing traders, okay, they're out there doing these things, high frequency all day long. They're entering on this because they see this was the qualifier to say, okay, we're going to go higher. Now, if it would have closed below this quadrant level there, they're not going to take that trade. They're not going to be in it. Even if it does go up a little bit higher here, it might go there and then roll right back out of it. That's why these things are important. That's why I'm teaching it to you. Those are the little telltale signs that I call a signature that we're looking for in price. If it's not there, I'm not taking the trade. If it's not there, I'm not holding the trade. If it's not there, I'm not going to reach for another objective to take a partial. Where's the next level in quadrant? It's the consequent encroachment. It reaches energetically right here. Where's the close on it? Above it. What's that telling you? It's going to keep fucking going up. Okay? It's going to keep going up. That's logic, folks. That's how it's done. That's real fucking order flow. Save your bullshit, level 2 bullshit, okay? These ladders, these DOMs, that's all horse shit. That is all gimmick. It's fucking gimmick. Everything is measured and everything is time delivered. Everything is. You honestly fucking think that these people are going to let their entire ability to get rich every single fucking day and control every step of every financial institution, every country, all of it's at the risk of all of us as speculators that if we all collectively got together and we short sell it, we could send this shit into oblivion, right? That's what you fucking believe? Just like the people on Reddit, just like they believe that. How did that work for them? How did that work? AMC, where the fuck's that stock at? You're not going to beat them. It's their fucking casino. So you might as well warm up to the idea it's beneficial that it's rigged. It's a good thing that it's rigged. I wouldn't fucking trade in it if it wasn't rigged. How are you going to be able to know for certain what you're doing has any edge? You don't. You're fucking gambling if it's like that. It's gambling if you're doing it that way. Upper quadrant. Does it close above it? Oh, hell yeah. So that means it's going to reach for what? The upper end of the inefficiency, that blue shaded area. And bang, 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 up here. See that? So let's roll this back a little bit here, give you some more detail, and we'll find our way off of the NASDAQ. All right, if you look at this low here, this is just swing projections. Excuse me. All right, so if you're looking at just these 2 points here, this low and this high, if price were to break through that, we can anticipate all of these levels here. Now, I use these levels like this one here. It's real hard to see. I apologize. But if you look real close, you'll see that that is a quadrant. I'm not a quadrant. It's a standard deviation. And it is close to that one right there. That's what? It's the first quadrant of that daily volume imbalance. And that's why we see it hit there and it consolidates. Then, reaching up into -3 standard deviation, we get 1, 2, 3, 4 times outside of these candlesticks. It's really trying to get to that level. So when I'm teaching you in Core Content Month 5, where I'm teaching standard deviations, I'm looking for these kind of agreements, these confluences of where certain PD arrays and those levels within a PD array that I are teaching you are influential in terms of price, where there's a collection of them, where they're coming together, coming together in a convergence. That's more impactful than some bullshit trend line, okay, or some kind of indicator. Because all those things that you're adding to your chart with lipstick and stuff, that's a religion. You're believing something for the sake of believing it, versus these are factors that the market's going to reach for on the basis of inefficiency. So if we know, and I'll put it like this, if we know that it's likely to draw up into this blue shaded area, what did we talk about down here? They're mohawks, right? I mean, you can color outside the line. It can go to where you think it's going to go, but just go past it just a little bit, because everything has to allow for what? The spread. So the algorithms that these high frequency trading algorithms are handshaking with the algorithm that books and delivers price. Make it short and sweet. The algorithm that causes the high and low of the form, that's predetermined before anything happens in the day. The high and low is already predetermined. It's already predetermined. I know some of you don't want to believe that. Okay, I'll let you believe whatever you believe. I gotta get a power cord here. Give me a second, 1 second. This is a bathroom break, intermission. Breaking hearts. Breaking hearts. This guy's ruining my mentorships. Fuck your mentorships. All right, so okay, we're looking at the aspects of mohawks. Okay, trading outside the levels, coloring outside the lines, if you will. That's what I refer to as something that's permissible. That means we don't look at it as less than efficient. We don't look at it as less than precision. We don't look at it as noise. We anticipate very specific things to see price draw to. Okay. If this inefficiency here that's shaded in blue is on the daily chart, that means that we're going to be now considering its quadrants because it's large enough to be referring to it. Contrast that with this down here. Okay, it's so small. It's not essential. There's not much of a difference between the low, the high, and let me scrunch it back up so you can see again what I'm referring to. It's the balanced price range over here that's going to act just like an inversion fair value gap. Trades down into what? If it's an inversion fair value gap, we want to see it respect consequent encroachment, which is midpoint. Can it trade to the lower end? Yes. But it's not likely to do that if it's coupled with a balanced price range where price goes up and down. So it's traversed between these two price points of this candle's body and this candle's body and that one. It's offered buy side and sell side. So it's efficiently delivered and booked price between those two price levels, which is what I'm highlighting here. But when price was trading down here, I was telling you at the time of me doing the execution, internalize it the same way I've taught you a inversion fair value gap, which would be treated as support. Now, do we simply just trade it on the high of it? You can, plus a tick or so. Sure, you can. But your stop loss has to be at least considering the fact that it can do this little mohawk thing. It can do that right to that low if it's an inversion fair value gap. So in other words, it can create just one tick or two below that. But it's not likely, highly probable that it won't do that because it's coupled to a balanced price range where price has gone up and down within those very specific price points. That's why consequent encroachment stops it here and stops it here. The bodies confirm while you're watching price because it doesn't close below the consequent encroachment. So if we're anticipating and allowing for a mohawk, something that's just outside the lines of what we're anticipating and seeing as impactful, noteworthy in the trade, in the tape reading, in the price delivery, we're not reducing its level of precision. When it does this, we are already expecting it. That's all that this is right here. This right here on a 1 minute chart, you can see the bodies of the candles here. But if you go up to like a 5 minute chart, that's just going to be a wick. Well, let's just do it. See how it's a wick? So this is a mohawk inside of the daily volume imbalance. So it's not a matter of, oh, it's the algorithm's changing. Look, it's not respecting. It's doing everything that it would normally do. But your trades and how you, and if you automate what you're trying to learn from me, and you create your own algorithm, and you can do that, those things will handshake with the algorithm that delivers price. Okay, the algorithm is going to determine the high and low of the day before we start trading in midnight, New York local time. At that moment, right then and there, the high and low is already determined. It's already determined. I don't give a fuck. Your heroes, everybody out there, whatever ICT says, it doesn't fucking matter. The high and low is already predetermined. What I've given you is resources to lean on to help you determine what that is. As close as I can, that's what I've done. Now, if you know that it's a high probability that's going to create a high or low of the day based on something like this daily volume imbalance. Okay, in other words, we're bearish. We've been bearish on the indices. If we think that it's going to go up to go down, And we can run numbers on the range at midnight. Then we run the range again at 8:30. Run the range again at 9:30. Where's the highest high and the lowest low? And what does it still have in play for a reach or draw on liquidity? That daily volume imbalance. When we go to a daily chart, I know, look at how much I've taught just here, and we haven't, just by 1 minute, not even a minute really, on the 5-minute chart. Everything I've talked about here just on this 1-minute chart. It's deep, folks. It's fucking PhD level shit. Like, I can't take 30 years and compress it into a 5-minute trainer because you're fucking lazy. I can't do that. I can't do it. No one can. Now, I can talk and introduce things conceptually, and you're going to have 1,000 different questions. But when I'm teaching, and I already know what questions you're going to ask. As soon as I'm saying something, I already know what questions are rising up in your head. But you have to lean on other supporting topics and things I've already made available on this YouTube channel for free. You dig into it. But you don't need to have this level of, well, madness. Okay. I need to know why it does it. Not just simply, is it likely to do it? No, I need to know why it will do it. I need to know when it will do it. I need to know when it won't do it. That's the thing that's been a driving passion for me. So we see this area here as a small little deviation outside of what we were expecting, which is that blue shaded area. Okay. So now with these quadrants out, we'll take that out of there. I'll take this lipstick off. If we were looking at it from the scope of the bodies, right there, because I teach this also in the core content, where price should be reaching for a range that's based on both wicks and in the bodies. Okay. And since we're looking at the 1-minute chart and we're trying to execute on the 1-minute chart, this is where you would have that there. It's calling for 71. So 71, it still has a deviation outside of that. Does that change or indicate that this algorithm is somehow now changing or morphing or no longer works? No. You have to come to the conclusion that your exits don't require perfection. Your entries don't even require perfection. If you trade with a measure of leverage that is reasonable, it's sober, okay? In other words, you're not trying to do 15 fucking contracts because Top Step said you can do 15 contracts. That's gambling. That's absolutely gambling. That's absolutely making sure that you won't be successful. Nobody should be impressed when someone's trading with 15 contracts and they get big wins, because that is a lottery win. There's people winning the lottery all the time. But how many resets are they going to do? You've already seen, I've been very candid. My son has done multiple times doing that. And he's done it very quick every single time he tried to do the 15 contracts. He tried to go back and do it again, and same thing happened. So the moral of the story is what? Trade with the least. Give yourself the ability to stay in a trade without having all the, I guess, the fear, anxiety. What if I do it wrong? If you're trading with the smallest degree of leverage, it shouldn't matter. It won't matter, really. But see, you're trying to press into every transaction and every moment you're in front of these charts that it's making you lots of money. And that's the fool's way of learning how to do this. Nobody gets to the finish line fast, profitable, doing it that way. Nobody has ever done it that way and has found consistently profitable and hugely profitable. No one has ever done that. Nobody has ever done that. You're not going to be the person that does it. And you're going to prolong this learning curve for yourself, thinking that you're going to speed through it because you're doing it that way. I'll learn how to trade by trading with real money. I can only learn if I do it with real money. I won't appreciate the lessons. No, you're going to get scar tissue. You're going to be scared because you've taken real losses while you shouldn't have done anything. You don't know shit about trading. You don't know anything about yourself as a trader. You don't know what you're going to do to wreck yourself, but you're going to learn those lessons painfully and attach that to money. And your subconscious is going to look at these charts and say, Yeah, it might do that, but the last time I touched that, I got a lot of money taken out of my ass, and I don't want to do that again. So what did you learn? You learned to be scared. You learned to be afraid to take a trade. You learned to be fearful instead of following a model. Well fucking done. You didn't listen. But some of you think that you're the exception. You're not going to be the exception. You're going to be just like everyone else as a statistic. You're doing all the wrong things, thinking that you're going to be the one that can skate through it with no problem. And it's not going to work for you like that. All right. And this is your fulcrum point right there. So from the low to that swing high there, if it breaks above that, you can look for objectives here. And this one just falls short of that. So you never got that. And the last one on the bodies. Just falls short of that one there. Okay, so I wanted to use this one here, and I wanted to use a limit order that would have never been filled based on this logic, because I was going to exit just below that by a little bit, and it never would have filled it. I wanted to have 0.75, and the high was 50. So yeah, 14,476 and a half, and I wanted to be out at 14,476.75. And had I done that, you would have seen me not get the exit, and I would have ended up closing it down here or stopped out, and missed the actual high point. But I was exiting right at the high end, above the upper quadrant, but before getting to that high of the blue shaded area. So that's how and why I managed it the way I did, and where my partials were and whatnot. But all these things in here, you're not going to find this stuff here on support and resistance. What I just outlined, all this stuff, that's not support and resistance. That's not Gann. That's not Wyckoff. That's not supply and demand. It's not anything but mine. It's a language that I created because I know things that you're not going to find in books, and no one else is going to step out here and teach you it. If they knew it, they'd be doing it. If they could come close to it, they'd be showing you. So you either make the decision, either you subscribe to the idea that these markets are algorithmic, and if you do, use the things that I'm teaching you, and it'll be easier for you to trust the time that it takes for you to learn how to do it. If you don't want to believe there's an algorithm, you're going to constantly wrestle internally that I'm wasting my time because you don't believe there's an algorithm. You think this is a free market. It's not. It's a rigged market. And you should not be upset about it. You should not be mad about it, because common sense should tell you that countries and central banks would not allow outside influences to muscle and strong arm it into oblivion. Because if this really, really was a free market, you don't think that the actors around the world that don't like our U.S. markets wouldn't sink it any given day? You don't ask the right question. You don't ask the right questions. It's like you drink the same Kool-Aid. In this industry, and the people that are in it with their little titles and bullshit, they learn from this person. This person tells me the market does this, but these people aren't going to tell you with a 1 minute fucking chart, with a 15-second chart, this is where it's going to turn on a fucking dime. It's going to go somewhere else. If it wasn't rigged, if it wasn't algorithmic, there's no fucking way anybody could do that. Let alone me, little demo baller from Middle River, Maryland. Oh, I'm having so much fun. Anyway, let's spread this out a little bit more and give you some detail about market maker sell models and buy models. So if we're anticipating the market is likely to continue going lower, because longer term and higher time frame, we've been saying that we're trying not to pick a bottom. Okay, so you have to open yourself up to the likelihood that every new opportunity in the marketplace intraday should be more heavily weighted on creating short opportunities. It doesn't matter that I did all this buying in here and it looked really pretty and it was nice. And some of you did the same stuff that I did today, which is great. That's a testimony that you have learned a language that works, and you are able to find a model in your own hands. Do it without me, because I didn't make it public to you. I didn't tell you what I wanted to do today. I executed on the things I teach you, though. But if you are looking for shorts you would anticipate the market drawing up into this area here. And I guess it's fine time to show you what this is. I've been talking about this one time frame. Let's go up to a daily chart. I guess this is a good time to invite you to, if you are learning today, this is one of those times where you can click that little thumbs up button. It doesn't charge you anything. Your PayPal won't have any transactions against it. Your credit card won't be swiped. I promise you, it will be free. But it's an encouragement that you found some insightful information today, because I'm literally giving you stuff that charter members are learning with you. You're learning insights and things that I'm brushing over that are going to be topics in books that you really don't need these levels of understanding. You don't need it, because what I've already simplified on my YouTube channel with the models I've given, it's straightforward, simple things. You just have to understand how to read the tape, and that's being in front of the chart and seeing the things I've already given you as rules, how they repeat all the time. They repeat all the time. It's every week, every day, and it won't stop. So this candlestick's close here. And then the very next candlestick, and again, this is daily chart. So every candlestick here is a daily representation of the highest high and the lowest low, where it started trading, where it stopped trading. Okay. I'll add this because this is my last video. This set button here, I use this interchangeably. So if I click this, it changes sometimes a little bit. You can see, watch this candlestick up here. Okay. Watch the close of it. It'll change. See how it's a little bit higher there? It's lower there. I use both readings. I use both readings because I want to have those levels in mind, because traders are going to have it toggled on sometimes, and sometimes they're not going to have it toggled on. So I want to know what retail is doing, and a lot of retail uses TradingView. And it's not a knock against TradingView. I love this resource. If I didn't like it, I wouldn't use it. Okay. Should you use it for your own trading? That's something for you to determine. I get nothing from them. They've asked me to have an arrangement where, they give me something for telling you to use it. I said no, and that's 100% honesty. I have no affiliation with no one. If I tell you something, I like it, it's the truth. If I tell you it's bullshit, it's the truth. Okay? No one's influencing my opinion about anything. No one's going to get me to say something nice about something that isn't good. So it is what it is here. I don't sugarcoat anything. But just so you know that this is the settings I have here. So is it set on the blue? No, it's set to off. See that? So I used these two reference points right there. That's what that volume imbalance is. So that was in my chart this morning while I was taking the trade live. You watch me execute, you watch me manage the trade, and it was based on this logic that we were down here, and it's going to do what? Trade up here. But ICT, you're teaching support and resistance, buddy. You're just making it complicated. Why didn't it go up to that low? It broke below this low right here. Why didn't it go up there? Because it doesn't fucking need to go up there. It doesn't need to go there. It's not going to go there. Where's it going to go? Where I'm telling you it's going to go. The algorithm that delivers and books price, that's a predetermined, it's a scheduled event. It's going to happen whether you fucking own it or not, whether you buy it or short it. It doesn't matter how many people are buying it. It doesn't matter what the volume level is. It does not fucking matter. None of that shit matters. It's going to go up into this level here. Why does it need to go here? Why does it need to do that very thing right there, going up to that point? What's missing? Volume. Why would we say that? Because look, this candlestick's low right here. This candlestick's low. Well, I'll just borrow this. It went up to that level there. So if it's support resistance, why not just use this daily low? Because it's not fucking support resistance. Why didn't it stop at this previous daily high? Because it's not fucking support and resistance. So what am I looking at? I'm looking at the difference between these two candlesticks' bodies. Even though they are joining and slightly overlapping with these two wicks here, this candlestick's wick and this candlestick's tail. Let me elongate a little bit so you can see it. So this one has a little bit of a tail underneath it, and this one has a little bit of a wick on the upside. Okay, you see that? The fact that it doesn't have a body overlapping the close to open of these two candlesticks, the algorithm will reprice to that. Do not take my fucking word for it. Go back and look at your charts. It's happening all the time on every single time frame, even on 5-second charts. That they're going to say is noise. It's not noise. It's not fucking noise, okay? The systems that run these booking engines that create price fluctuations that you think are random acts of buying and selling pressure, they're starting from a lower time frame, working their way up to a higher time frame. And then they cycle down from that higher time frame back down to the lower time frame. They're doing this all day long, all night long. That's what's going on. It's a price delivery continuum that starts from the lower time frames, moves up to the higher time frames, and once it fulfills the higher time frame, then it starts dropping back down into lower time frames. And it's not just time frames that you see me point to, and I'm not telling you what they are. So don't fucking ask me. I'm not going to do it. I don't give a fuck who asks me. You're never going to get it out of me, period. But I had to create a language that you guys can use because it's extremely much more complicated than I'm showing you here. And if you understood how much of a complicated subject matter this is, it's a miracle that I got this far with it. Like, for you to be able to see this is a success for me. I can see how you all have learned from it. And that's what I needed. I needed to see that if I could create that. So I know I've been over the target, and now there's nothing anybody can do to punish me because I didn't teach you exactly what I know that I can't teach you. But it's close enough that you guys are now murdering these fucking markets, and they can't fucking stop you. They can't tell you you can't come to the table. There's too many of you. There's too many of you. So fuck you. How's that work for you? So there is a volume imbalance in here because the bodies are not overlapping that gap between the two bodies here. So the close of this candle and the open of that candle, it's lacking a candlestick body. You see that? So what does that mean? That means that range that I'm highlighting here can be revisited. Now, Chris Laurie and anyone else that talks about those inefficiencies, those imbalances, those liquidity voids, that's not a liquidity void. This is an inefficiency. Okay, a liquidity void is an actual gap between one period to another, where there is no wick, there is no body. That is a liquidity void. It's void of all liquidity. This is not a liquidity void. There was buying and selling in between the close and the low. There was buying and selling between the open and the high. Both of those two price points or two time intervals in the individual daily candlesticks, they both intersected and overlapped a little bit there. So that is not a void. It's not a void. It's inefficient. So what is it needing here? What does it need? And if we open down here on a Monday of non-farm payroll week in a market that's highly destabilized because of all the geopolitical things and war savoring going on, there's no economic reason to own stocks. They're absolutely inflated. There's no fundamental reason to be long stocks. And I was laughed at a month and a half ago when I said it was going to go lower. And people are blocking and trolling me from silence now. They found out that we were right. It did what we said it was going to do. Because what I'm teaching you is the market. It is the market. It's not patterns. It's not theory. It's the market. It's what the market's going to do. So if it's an inefficiency like this where there's no bodies, we can anticipate the market wanting to reprice up into that. Even if it goes higher, it doesn't matter. That gives you an opportunity to do what? Sell short here and reach for the liquidity that was used prior to the run up. But if it's bearish, this is a wonderful area to see price draw up into, thinking what? We created a low, we created a bottom, because the stock market by itself is predisposed to go where? Up. It's ingrained in everybody's mind to buy stock. Buy stock. Buy the stock market. Be a holder. So that premise is constantly primed in the thought processes of traders. I want to buy stock. I want to buy call options. I want to buy something. So if we open up here, it gives you the inclination that, well, hey, look, we gapped up higher from where we closed on Friday. So that it gapped up. We traded down a little bit. Okay, wonderful. And then sent it up to a level that is predetermined, that these exist. I taught it to you. It's there. That blue shaded area was in my chart from the time my trade opened until I managed the close of it. That's not random. But the logic was it's going to offer a revisiting of this area because there's no body. Now, there still isn't a body. It's just a wick. Today's wick went there today. And volume imbalances, we know that it's likely to go through them. That's one of the PD arrays that you have to have a lot of flexibility. And they can also be used multiple times until, this is for your notes for the folks that aren't writing anything down, once there's a body laid over top of the close, the open here, whether it be an up close or a down close, once the body is laid across that, I'm not going to refer back to that volume imbalance ever again. That's not to say that you can't use it again. I'm saying that I won't use it. That means it's expired at that point. But it will not expire at all until there's a body laid across this range. And this is just a wick, okay? So there's logic there. There's sound logic being employed there. It's not just some conjecture. It's something that I've taught my students. It's something I use in trade examples that I'm showing you. I use it in my analysis when I'm talking to you on these higher time frame charts. You've seen me doing it now for a year and a half publicly now. What have you seen me get wrong? Short list. It's a very short list, isn't it? So I'm counseling you to don't just take my word for it. Go back and look at the things I've taught you and see if you see them in the chart. And you're going to be convinced rather quickly that it's there. So then you have to sit in front of the charts and learn how to see them happening real time. In the beginning, you're not going to know what it looks like before it happens. But then over time, you'll start recognizing things. Oh, I've seen this before. This is like that thing he talked about. And then boom, there it is. Every one of my students have the same epiphany. Not at the same time, not the same length of time, but they all have the same thing. Wow, it happened when I wasn't really expecting it. It just happened, and I can see it now. But once you understand it and you see it, you can't unsee it, but you can't rush it either. And that's the part I wish I was better at in as a teacher to help you with that. But in my honesty, I don't think there's a way to do it because all of us bring our own baggage to it. The things that we wrestle with the most. So that's the imbalance, the volume imbalance on the daily chart. And we've dropped down to a 4-hour chart now. You see how even on the 4-hour chart we have that. But look, was that a candlestick body? Nope. But on the 4-hour, what do we have here? Did it close over top of that with a body? Nope. It still had this portion here. So this is still in play. It can be utilized again. It's not expired. 60-minute chart. Same thing. Did the body close it in on any one of these candlesticks? Nope. So that does what for me? It tells me that this needs to stay on my chart. If we go into a time frame, hourly, 4-hour, or daily, and a body is laid over top of it, why am I using these time frames? Shit, he just read my mind. Why not any other time frame lower than that? Because 1 hour, 4-hour, and daily are my swing trading time frames, and I don't want to use a daily volume imbalance and cancel it with something less than an hourly chart. Look at my core content lessons where I talk about how using one time frame with another time frame to qualify another trade. I talk about that in greater detail. I'm not going to waste my time with it here because I've already done it. A long-winded discussion there with real examples and how to think about moving one time frame to the next if I'm swing trading, short-term trading, or day trading. All right, so let's look at the 15-minute time frame just for the sake of market structure. And even on the 15-minute time frame, it didn't quite close it in with the body. So you can see how it's done. Everything I'm teaching you how to use a volume imbalance, all those signatures are still here. Okay. So in short, what that means is it can still run back up here and touch the low end or consequent encroachment of it and not get up here and still go lower. Or it can go all the way up and close it in and go lower. That's one of the things that we could probably see because it's not farm payroll week. So to me, like I'm done. Like I'm content. $17,000, one clip on a Monday of non-farm payroll, delivered beautifully with precision. I'm satisfied. Like I'm done. I'm good. I don't need to do anything else in the PM session today. I don't need to do anything on Tuesday. I don't need to trade on Wednesday to squeeze something else out. And I certainly don't need to do anything on Thursday and Friday of non-farm payroll. But contrast that with every other retail trader out there. They're anticipating a lot of movement on Friday. So they have their hopes set up for a lot of action on Friday. And that's something that I tried to steer all of my students away from, because you shouldn't be excited about taking the trade. It should be boring. You should be bored out of your mind that I'm going to do something I've been doing, and it's probably going to do the same thing I expect to see happen any other time. But you're not excited about it. Now, that doesn't mean like I'm grinning, this morning when it delivered like I wanted it to. Well, I mean, I even typed it out, right? Cakewalk and smiley face. Because it's stuff that I teach, and it just keeps delivering. And I'm not questioning the efficacy of this in the future, because, even if I was to triple Larry Williams' record next year, which I'm not aiming to do that, by the way, the idea of drawing more attention to all this stuff, it's not going to change anything, folks. Because the fundamental basis of which the market's book price, that won't change. Because they're never going to let it be buying and selling pressure to control it. So forget about it. You ain't got to worry about that. They're always going to manipulate it and control it. So there's going to be a predetermined high and low. Who cares? And even if they do increase the level of manipulation, so what? They can't create a seek and destroy day every single day, because nobody will ever invest. So why the fuck are you worrying about shit that ain't something to worry about? You're going to have a losing trade. You're going to get stopped out once in a while. It doesn't change anything. It doesn't change anything. But it changes everything if you expect that you're going to be able to go out here and trade with never a losing trade, or make lots of money with no real drawdown. Like that's unrealistic. That's unrealistic. And it's important that you understand that, okay? All right, so now let's go over to ES. I know, like, man, alive, we're going to get into another market, Michael? This is ridiculous. I trade Forex, and you're still talking about this stuff. All right, so let's go to a daily. All righty. Let's scribble on over here. Relative equal lows. Sell side would be residing below that. Nice. Reach there last week. And what's resting right here? You see that? What is that? We've been talking about it all morning, right? What is that? What's that PD array called? Volume imbalance. That should be on your chart. I believe that we'll probably see S&Ps traded to between now and 8:30 on Friday. Now, what does that mean? Is that an invitation for you to trade? No, it's an invitation for you to study. It might not do it. It might not trade there. It could just fall out of bed and never go there this week or the rest of the year. I'm saying that because we have a fair value gap between this candle's low and this candle's high, but we have a volume imbalance. So your entire range shaded there should be this. That's how you should have it on your chart, because you can't ignore a volume imbalance if it's part of, or what would be part of, a fair value gap. So if there ever is a separation between two candles that would otherwise be like this would be a normal fair value gap, right? You would expect that. But I taught you that you have to use the volume imbalance in concert with that fair value gap, because that's the range they're going to use. Because if you don't do that, you won't have the real consequent encroachment. You won't have the real halfway point. You won't have the real upper and lower quadrant levels. See the importance of that? So it's really important to know that just because I introduce something doesn't mean that you know it. You should go out there and risk more money.